started here. Today we have Arthur from DeFiance Capital and Ivan. I am Luke. Most of you have seen me in Telegram, Reddit, and email, or in my DMs. Ivan is the co-founder of Switcheo, one of the leading developers that includes protocols of Switcheo, TradeHub, ZilSwap, and DMAX. As I said, Arthur is the founder of DeFiance Capital, and they have invested in a lot of heavy hitter cryptocurrencies. These include Switcheo, Ava, and Syntex, among others. Now we are just going to rotate. The first question is, 2020 has been a defining year for crypto and DeFi in general. As the space continues to mature and evolve, we've observed crypto derivatives gaining more traction and volume. What do you think is lacking on layer one derivative protocols, and what needs to be improved upon? Ivan, you can go first.
Yeah, so layer one protocols, I think Arthur won't have a problem because it's a real whale. So I guess the main issue is that it's about Ethereum and gas fees, right? So yeah, I think that's what most people are trying to solve currently. In Synthetics is doing their O2 what do you call it? O2, right? Optimistic rollup, and a lot of other people, a lot of other players, they're just trying to build bridges to solve that problem and using other layer ones as the main application layer. And of course, I think at the end of the day, for layer one, the main issue is going to be how much complexity each blockchain can take. And I know others, you are very bullish on Ethereum. But at the end of the day, there's a max limit in terms of how much you can execute in each block, and there's a maximum number of instructions. And yeah, so I think that's going to be a more challenging technical issue to solve, because at the end of the day, there's always a compromise. If let's say even if you try to offload things to layer 2, it does actually mean that you are losing something else, whether it's interoperability, whether it's security, or even decentralization, like become less essentially listed. I think that's going to be the main technical problem for layer 1, not just for derivatives, actually for everything. Yeah.
A lot of people are complaining about the gas prices right now, and something needs to be done. Arthur, do you have anything to add to that?
I think it's pretty clear. First of all, scaling issue. It cannot process that. Currently, most of the layer 1 protocol, except for Solana, cannot process that many transactions. So as a result of this, the derivative protocol right now, they cannot allow a leverage that's usually higher than 10 times, which is pale in comparison to the centralized exchange where they can offer you 100x leverage. I think this is one key issue, the scaling driven leverage, lack of leverage. Another one is definitely the gas cost. A lot of the protocol have a way of getting around it by using layer 2, but I would say the overall user experience is still suboptimal compared to many centralized exchanges. So I think that one reason the spot exchanges can compete, the spot decentralized exchange can compete with the centralized spot exchange is actually that in terms of user experience, the spot exchanges are getting quite close, especially when it comes to liquidity in certain long-tail assets. And even for certain like a major assets such as Ethereum, the liquidity on the DEX right now is pretty superior, and this actually offers a user a level of UI UX that's very comparable. But for derivative, we are still quite far away from achieving that. So I think this is the two things that definitely need to be improved on: the leverage and the entire speed and fee of using a derivative protocol right now. And on the current trajectory, I think that we are on track to tackle a lot of this issue. So I think there's a few that I think is quite promising right now. Synthetics optimism integration is still at stage 1. And I think that yes, I think when you're moving to layer 2 protocol, you will lose some of the composability. That is certainly a trade-off. But actually, I would say that derivative protocol is one of the segment in DeFi that actually can afford the trade-off of composability. The reason because is when you're trading derivative, it's actually an entirely different set of product compared to a spot. You need a market maker to arbitrage between the price between the spot and the derivative, but the composability benefit is not as much as you're doing spot where you can borrow from Aave and compound, etc. So let's say for DeFi they've been running this order book model, and you have always need to deposit your holding your balances into their specific smart contract to trade. And so the composability between DeFi and other protocols has always been not as much since the beginning, but they have still been able to achieve around 30 to 50 million volume a day consistently over the last 2 months, even with the lack of composability. And I do think that for derivative, this is a trade-off that is acceptable to make. So yeah, and I think in that sense, layer 2 will be a pretty good outcome for most of the DeFi derivative protocol.
Yeah, actually, regarding derivatives, regarding derivatives, I think it's true to a certain extent if it's cash settled. But I think one interesting thing that people are not actually doing right now is physical settlement. So you can actually physically deliver the futures expiring for let's say Bitcoin or Ethereum, then you actually do kind of want a spot market so that you can do trades that are linked, right? So you can execute the trade at the same time atomically. And I think when market gets more sophisticated, that will be something that a lot of people will start looking at. Yeah, but I think for now, I think what we're doing is basically trying to go for the scaling, don't care so much about the composability angle. And I think for us, that's kind of our angle as well.
Thank you. Now the second question is kind of an expansion of that first question. There's been different proposed solutions to these problems by different teams, such as ZK rollups by Luke Brang, optimistic rollups by Deriva Dex, and a new sidechain altogether, which TradeHub DMEX has done. There doesn't seem to be a one-size-fits-all solution to this. Which one do you think will win out? Arthur, can you take this one first? Which of these do you think will win out?
I think it's too early to say. Really, I think you get different answer no matter who you ask. I think that currently the leader is definitely the ZK rollup and optimistic rollup because they are to a big extent benefited from the security of Ethereum main chain. Especially for ZK rollup, it's like they're using zero knowledge proof to basically scale the transaction. Optimistic rollup is slightly less secure in a way, depending on who you ask, than ZK rollup. But I mean, there is a way for people to submit a fraud proof and to anchor the security to the main chain as well. So I think this tool is a front runner right now. So creating a new side chain, that has always been a more challenging way. I think that obviously there's a few other that are attempting this. DMEX is one, Solana is one as well. But you need to create you need to get a user base to move over, which is it take a lot more like an outreach effort as well, because they need to learn to use a new set of wallet and all this thing. So even like for Binance Smart Chain, they're entirely forked Etherscan and MetaMask. I would say that they have a decent user, but there's not enough like a genuine organic user on Binance Smart Chain compared to Ethereum, although the fee is way lower. So it's very hard to say which one will be the most successful, and probably I think only time can tell us the answer as well. I think that it's too early to say.
I kind of disagree in terms of the Binance chain angle. Actually, I think there's quite a lot of organic users who actually go and take down. Maybe you can look into it. And I'm also surprised why. I think it's mainly just the Binance name and people are like just more confident of trying to hop over to this chain. And the other thing also because they just fork UVM directly, right? So all you need to do is just change MetaMask, add one network setting, and then okay, you have a binary chain wallet. And so that actually reduces the gap a lot. And yeah, I found that quite interesting. In terms of user base, I've been looking at Binance Smart Chain. I don't know how decentralized or whatever it is. So the thing is that with these kind of returns, I think a lot of people don't care, and that's why it's also getting a lot of traction. And the use there right now, if you're still into yield farming, is like insane, especially with the stablecoin and whatever. So that's one thing. Regarding like sidechain versus like what technology you use to anchor the security, I think for that one, yeah, it's kind of early to tell. But the other thing also, from a technical perspective, right, it's two different concepts regarding the sidechain and the security layer. So for example, DMAX could actually easily convert into using optimistic rollup or ZK rollup as a security mechanism. All you do is you change the deposit contract, and then you make sure that the sidechain generates the proofs. So I think that's a technical distinction a lot of people don't apply. And the advantage of building a sidechain first is that you get all the application logic ready. It's able to do all these things, and then later on, when let's say the technology is mature enough, it's general enough that you can encode that, you can basically convert the transactions into proofs and then put it onto the layer one chain. Only then you do that, rather than investing time into trying to conform your transactions or whatever data into the format that's required. That's still in active development. So yeah, I think that's something that to point out also.
Thank you, Ivan. Third question is automated market maker dexes versus order book dexes. This has been a highly debated topic for a while. Arthur, you've elaborated the strengths and limitations of both models in an Uncommon Core podcast episode. DMAX combines the two in a way that hasn't really been done before. How does this resolve some of the limitations of each model, and what does it actually translate to for users? Ivan, since you designed it, can you take this one first?
Yeah, so the reason why like all our Switcheo products basically always have order book is because I always believe that at the end of the day, that's what it's going to end up with. You still need a CLOB at the end of the day. And liquidity pools and AMMs, there's actually two components to it, right? There's the liquidity pool angle where you can automatically market make, and then the interface where you do the swap without order book. That's actually a different concept altogether. You can have a swap sort of interface with CLOB as well, and without AMM, without a liquidity pool. It's basically just market order. So I always found that from a trader perspective, it's good to have you should engineer it such that it can support a CLOB, because a CLOB can always be abstracted into like a swap model. For the liquidity side of things, automated market maker is basically just a algorithm on top of a pool of funds that can basically quote for a certain price, for a certain size. So that's how we always thought of things, and we try to build it such that it benefits the user of each component. So for the liquidity pool side, you just want to try to make money with your assets in a way that's very easy. You just dump the money there and hope that it grows. For the trader side of things though, there's basically two sets of users. There's the more technical users or the more sophisticated traders who want to use the limit order books. Then on the retail user, let's say, or the DeFi user side, you just want to get in and get out fast, and then you want the sort of swap model. So and that's why the way we want to build it is that you get the most complex mechanism for both components, and then if you want to now support like the less sophisticated user, you just build a swap module on top of it, and that's actually what we intend to do in future on top of whatever we have now.
Are there, for people that haven't heard the Uncommon Core podcast, can you give us some of the expert you had from that on automated market makers versus order book?
Yeah, I think Ivan have illustrated it quite well. So, I think that AMM is just like it opens up a new way for retail to contribute their liquidity to the project they want to support. And although there's a lot of downside and trade-off, most people underestimated how big this segment of the market is. There is a lot of the users who are willing to contribute liquidity, even with the potential of permanent loss, to provide liquidity for a project they want to support. And obviously, and if you believe in like these two pair of assets will mean revert over the certain time frame, it's actually your impermanent loss will be recovered anyway. So I think that is a new frontier that has not been done before, and that's why that this is actually I think it's a real innovation. For order book DEX, I think it's definitely the more a better option for the more sophisticated user. So I think both have their need to coexist in this market, and if you combine both of them, I do think that is considered best of the both worlds. But in reality, we are seeing that the user who like to use the AMM model, there are some. I mean, a lot of them are like a pure like a simple user. They just want a very simple user experience. So I think how do you translate this? That when you're using an order book, although you do get the AMM, but how do user get this kind of like a direct understanding that okay, they're actually putting their order through AMM as well. I think that is the key challenges. So I think that it's really about giving them a good user experience that is very comparable, like clicking two buttons on Uniswap. Yeah.
Fourth question is, Arthur Cheong, well-known developer and founder of Yearn Finance, recently posted a sequel to his infamous rant, "Building in DeFi Sucks," citing disloyal, even potentially abusive attitude towards DeFi developers and how projects are valued based upon their token prices rather than their fundamentals. Ivan as a developer and Arthur as an investor, I'm interested to hear your perspectives on the communities in DeFi, given how governance is now the feature model of almost every decentralized protocol. Do you think there is a right or wrong way to governance in DeFi? And are there any projects you feel have done a really good job with this model? Ivan, you want to go first?
To be honest, I don't have any strong opinion or strong feeling about this. I've always felt that price and product price and actual capability, price and value are two different things. Things can be misvalued and things can be overvalued, undervalued, etc. And a lot of times, I'm not fair. I read the post, but I forgot what the main concept was. There were some interesting and good points. But in terms of communities, there's always going to be people that are just chasing profits, and then there are people who see value. They're longer term outlook, or they just believe in your vision, or they just believe in your mission. So for me, I guess you just need to tune out people who are chasing profits. Even just say sell the token, whatever, because at the end of the day, as somebody who's building for a long term, it's going to be very hard to deal with people who are chasing this sort of harms, this sort of short-term profits, and going to distract the team from actually executing what they are doing. So it's actually better to get rid of such people and just keep executing, and then you just end up being supported by people who are long-term believers, people who are willing to weather not so good conditions lah. At the end of the day, at the end of the day, everybody in this space is a startup. Everybody is going to experience ups and downs, and And if whenever it's down, then you get distracted by a lot of this noise, then you're never going. It's going. Yeah, you're not going to go far. Yeah.
Arthur, as an investor and not as a developer and builder, what are your feelings on the communities in DeFi and the governance protocols model?
I think that the market is actually, I mean, there's obviously still a lot of inefficiency right now, but overall, it has actually gotten much more mature and sophisticated compared to 2 to 3 years ago. At least that you can see that over the last few months, like a lot of the old layer 1 coin, they have actually been underperforming a lot of the more like useful, such as the DeFi protocol has been climbing in ranking compared to the older layer 1 irrelevant protocol. So, and I think that yes, there's always going to be a group of people who say that the token price is basically using token price to reflect the fundamental of the protocol. But I do think a big extent that if a project have a good fundamental right now, usually it will be reflected in the token price as well. That doesn't mean that some of the protocol is not overvalued, but I'm saying that if a protocol have a good fundamental, it will usually be reflected in the token price right now. So I think they just keep on building. The market is there's a lot of sophisticated investors around that will saw a gem, will know how to identify a gem and support it in any way possible. So yeah, I do think that this is a issue that the market is generally solving on its own. And in terms of governance, I think that it's still a very early stage. We are all exploring how to implement the right way of governance. I do think that a pure one coin, one vote governance is pretty suboptimal in a way that you're gonna get the smaller token holder will not feel encouraged to participate because their vote unlikely to make any difference. So you end up giving the whales a lot of influence on the direction the protocol are taking. But again, that this seems, but there's also a discussion of what constitutes fairness, right? Why should whale be penalized for having more token holding? This should mean that they are more incentivized to make sure the protocol will be successful in the future. So I don't think there's a right answer, but if your aim is to encourage more participation across a wider group of holders, one coin, one vote seems to be a little bit more suboptimal. I think Synthetics have done it in a more elegant manner where they actually elected a council and even the voting for the council members have a quadratic function inside it. So the biggest holder doesn't have like the most influence in the sense compared to his token holding. So I think that's one of the more interesting way to do a governance. Yeah. So yeah, I think it really depends on the objective you want to achieve, and also at the early stage of the protocol, I think it's okay to centralize a little bit more power to the team as well, and only surface major decision for the community to vote on as well, such as what the Switcheo is doing. For the more major decision, they do have an on-chain vote, but for the smaller decisions such as like which on-chain pool to incentivize the liquidity, the team is the one making the decision. Yeah.
Yeah, regarding governance, I'm not sure if quadratic voting works for schemes where there's no like sort of council or there's no where basically everyone gets to directly vote because it can be kind of gamed pretty easily. So that's one of the problems. You can just create. I mean, yeah, basically you just get into a war with people who are trying to game the system. But I do think like the representative democracy sort of method is interesting and it could work. Even for like Switcheo Trade Hub and Cosmos-based system, there's sort of this system. I don't know whether it's explicitly meant to be like that, but implicitly, basically you follow your validators vote. So basically, they are basically you delegate decisions to them. So it's interesting, and we are still exploring like if this sort of models can be improved. Maybe we can like move away the representative vote to some other group or some other entity, such that you don't delegate to the validator, you delegate to some other representative, similar to how it works in most modern democracies. yeah. But overall, I think normally it's easier because of the fact that you cannot pretend to be more than one person in the real world. But in terms of digital, in terms of the digital space, that's one of the bigger barriers to implementing more complex sort of voting systems.
Thank you, Ivan. Our next question is, let's take a long-term view of DeFi. What gaps, challenges, and problems do you foresee for DeFi to cross and solve in the year 2021? Arthur?
Sorry, I think I muted. Yeah, I muted you just now.
The main challenge, I think we talked about previously, is definitely the scaling and the fee of using the network itself. I think that this is if you want to unlock more use cases, and this is I think quite necessary. It doesn't have to be like almost free, but it does have to be way lower than the current level. So yeah, I think performance, transaction per second, and also the fee of using the DeFi protocol, both of these need to come down, and this is probably the most obvious gap and challenges. Another one I think is having some sort of identity. I'm not sure the correct way to solve it, but by having some sort of identity in DeFi, you can unlock other use cases such as under collateralized lending as well. And yeah, so I think that this is probably one of the main gap as well. And yeah, I think that this is the main gap.
Yeah, for me, definitely scaling identity. I don't know if solving identity is the correct problem to solve, but maybe. For me though, I mean, as a user of DeFi as well, actually my main gripe with it is about the wallets and how, especially if cross-chain sort of DeFi is going to take off, which I believe it will to some extent, then our wallet technology and the way that people interact with DeFi, it's really, really lacking. So everyone uses MetaMask, but there's still a lot of loopholes in terms of MetaMask because of the way transactions and contracts are displayed in the wallet, on the app, etc. At the end of the day, you're just doing a lot of things blindly. Even with Ledger, there's a lot of data that you cannot verify, that it's very hard for a normal user to actually understand or to be very confident of. Because even me as somebody who builds DeFi, sometimes I don't know what the heck I'm doing. I just press approve because I just gotta do it, right? So I think that's a major the major gap that actually I'm kind of surprised no one has actually bothered solving. Probably because maybe it doesn't matter so much now. Everyone now is on the edge, right? Everyone is experimental. Like we are the first 5%, the first 10%. But I do feel that to actually appeal to both like larger institutions and also like the normal users, for them not to get wrecked, basically, we really need to improve this. And even and even at the end of the day, it's part of it should be part of the ethos, part of the mission that we're trying to build, to make sure that people can verify things on their own, people can actually be their independent bank. But we're going to have to trust like a lot of these processes, this sort of UX flows, then we are actually not fulfilling our objective as DeFi builders. Yeah, so actually I've been trying to push our community to also like build a MetaMask competitor, build something that is way better, because I believe it can be way better.
A lot of things in the space that can be improved upon. Now, the next set of questions are coming from community questions. Our first question comes from CoinsDaddy, Little Gains. The question is, tokenized stocks have become a hot topic recently. Arthur, are you able to break down and explain how tokenized stocks work?
I think there's a few ways to do tokenized stock. One is a pure synthetic. Basically, that is just like a derivative contract that represent an exposure to the stock. and you can just trade it around, and you'll be cash settled. It's usually quite challenging to do this due to a regulatory reason. In most countries, there's a very clear regulation around this, and I think US, they don't even allow CFD, which stands for contract for difference. And and there's a very strict regulation around stock equity derivative. Another way is to like how the FTX have done it. Basically, work with a company that actually can help to custody the actual stocks and just provide a front end and the KYC for user to access these tokenized stocks. And so this is how it's being done. They partner with a traditional financial institution which has the proper license to process these services, and then offer their user the capability to trade stocks. So I think this is the two ways being done, and I think that the popularity is mainly due to just that there's a resurgence in retail trading of stocks in general, and that's I think that's the main reason.
Stocks have been really hot here in the United States lately. Ivan, do you see tokenized stocks bringing value to this space? If so, what kind of value, and do you plan on bringing them to DMEX someday?
I haven't actually looked deeply into like how they're performing at FTX, and I think Miriam protocol and a few other protocols do have the first version of tokenized stocks where it's like it's collateralized, over collateralized, and then you have Oracle to liquidate. It's basically similar to how you would mint DAI or any synthetic asset on FNX. So problem with that is that there's no guarantee they maintain their peg, especially if the collateral drops too much. And at the end of the day, you're actually kind of trading synthetic, or you're trading a derivative, not really the actual stock. That though, it's like easiest technically for somebody like us to implement. All you need is to point the Oracle at Bloomberg or whatever, or whatever trusted source, and then you kind of have you can mint the stock using a CDP system. Whether it brings value, that is the main question, right? And I'm not very sure. The only value it will actually bring is if there is people that want to trade it but cannot trade it. And right now that market is not very big, I feel. It does exist though, and but I don't. It's just kind of riding the hype kind of thing. In my opinion, if DeFi actually takes off and it actually enters mass market, then people will be just issuing their stocks on chain directly. I think that's how I see it in 10 to 20 years. And this sort of collateralization of the stock market, it's kind of a temporary stopgap thing. So in terms of long term, I'm not super interested in it. But in terms of implementing or doing it, I'm like, sure, why not? Yeah.
A lot of my friends that trade stocks have wanted to get into tokenized stocks. They think it's easier to trade or get into on a DEX rather than transferring funds from a traditional bank to a traditional exchange. Next question. Oh, go. You have some to say on that?
Yeah. Perhaps if you're already crypto native, but I think the traditional finance network, if you're in one of the countries that like US, Singapore, then where actually most of the market for crypto is at, I don't think it's a huge problem. I'm not sure about US, but for Singapore, definitely it's pretty easy to get connected. So that's
the next question is involved automated market makers. It comes from Twitter user Will Speaks. It says, Ivan, how DMEX has an automated market making model. Do you think the incentives are sufficient enough to attract users to provide liquidity, given how impermanent loss is a big obstacle when users are wanting to provide liquidity? Do you think the incentives that we are giving, exchange fees, block rewards, are enough to combat the impermanent loss they may see when they're giving liquidity?
Right, this was regarding Switcheo or in general? Or okay, this is in general, right? So, incentives. I do think the real solution is to have more flexible EMM models so that you basically you're market making, right? So you just market make based on your outlook, based on your market direction. And then if it goes your way, then yeah, you're market making plus you traded your market direction. Right now, the problem is that the only way to do it is to bet on mean reversion, right? Like Arthur was saying, to do a sort of gradual, strategy where if one asset moves away, then you basically lose out. So the real solution, incentives is basically, I don't really see it as a pure stopgap. It's a stopgap plus also a marketing sort of play where you mean your governance tokens, you try to attract users. I don't think it should be something that the rewards must overcome the permanent loss. It should just be taken as a early adopter incentives sort of thing. And regarding solving the IL problem itself, that should be solved by creating more complex EMMs. For example, for DMAX, we use the balancer model because you can have hosts of different weights. So with different weights, you actually have a slightly different. It's basically different weights align with different market outlooks, whether it's bullish, bearish, etc. And of course, there are other models like the curve model, and for the derivative space, there's even more ways to do market making on derivative AMMs. So I think at the end of the day, that should be getting more EMM strategies, making the VOD flexible to be attached to multiple strategies. That's the end goal that we should be looking for, rather than and then the incentive is just early adopter sort of thing, rather than compensation for your IL.
Arthur, you've been in this space for quite a long time. Are there any other methods you find that have been successful in combating the issue of impermanent loss for automated market maker model?
I think there's no perfect solution for this. I think the common way is just to have quite a decent number of token subsidy to make up for the potential impermanent loss. Let's say that there is a lot of research being done to have a certain way of hedging the impermanent loss, and most of it have to do with on-chain options. So I think the key is whether the on-chain options can be priced in a way that will protect the impermanent loss. But if you go to a more theoretical level, it should all be on par, because arbitrager will just make sure that when you buy the protection is equal to your potential impermanent loss. So you actually net you're not making any money by buying a impermanent loss protection at the same time using options. So yeah, but again, that the option pricing might be priced in a way that's different from how the potential impermanent loss is the potential of impermanent loss. So I think it's still too early to say, but there's a lot of work being done to having on-chain option that can be buy directly to hedge against the impermanent loss.
Next question is, both of you guys are experienced traders and have been in this space for quite a while. The last few months have been really exciting because the prices of things have just been exploding. Our next question comes from Carmel Hombre. He's asking, Ivan, how have you learned to manage risk from your early days of trading to how you are now?
You just lose everything, then you realize how to manage risk. What's the question there?
Question is, how have you managed to manage risk in trading, and what are some of the mistakes you made when you first started out versus now when you trade?
Yeah, so I'm not. I'm more of a builder than a trader. I think Arthur's the trader here, or at least the investor. In terms of risk, I think in terms of personal risk, we people in the space usually generally have a higher risk tolerance. So you like they say, you need two bull markets, right? The first one to learn how to like earn $1 million. You need the second one to actually keep the $1 million. So I guess it goes the same for everyone. You just need to learn how to preserve your capital, learn how to figure out what actually works in long term. There's some other question, right, regarding this?
Stakes and manage risk, that's the two.
Yeah, so in terms of managing risk, I only can speak about like DeFi sort of risk. I do think that there's a lot of yield farming going on, but there's not enough risk management, and it goes back to the kind of what I said previously about MetaMask, etc. People are just degening in. So hopefully we will see like the on-chain insurance space pick up. So for the longest time, the insurance space has been very undervalued. I think that's actually, it's kind of interesting because in the traditional space, insurance is one of the largest sectors in terms of financial markets. Yeah.
Arthur, you have experience in traditional finance and crypto. Compared to traditional trading, how has crypto changed your outlook, strategies, and risk tolerance when it comes to trading?
I think that crypto definitely is much more volatile than traditional asset in many ways. So that I think that in a way it does train my mental tolerance for volatility. So that if something have a very high upside potential, even it's volatile, after a while you learn to accept that this is part of the attributes of asset class that can grow exponentially and have a huge upside in the future. So this definitely desensitizes you to volatility a lot more. And I think that crypto trading is also a lot more wild west in a way that a lot of things is being invented as we know on the view, so that you there's no fixed way about trading. It's always about learning the new way of trading and new information in the market. And yeah, and actually I think my biggest piece of advice is just to not trade. Most people will just not be able to outperform the professional trader, especially in crypto. I think that as there's way less regulation, there's a lot of things that you simply do not have the information to trade on it successfully. Especially for the smaller cap. I think for people Bitcoin and Ethereum, you can still do some technical analysis. You can place a stop loss, all this thing. But for most of the other coin, trust me, you do not know what is happening behind the scene and what is driving the movement of the cryptocurrency itself. So the better way is just to not trade and identify something that you really like and hold on to it. Yeah.
Right.
You have a rebut, Ivan?
No, I just say it's great advice.
Oh, okay. Sorry. Next question comes from Sonia Argerol. We know DeFi products are making financial applications a lot more exclusive and accessible to the masses. What do you think will take DeFi projects to the next level so that one becomes the next Robinhood? And how will they get there? Arthur, can you take this one first? What will make applications the next Robinhood?
The most simple answer is just time. I think that currently this space is a talent black hole. It's attracting some of the brightest mind in traditional finance to work on DeFi, because this is something where you can innovate in a very permissionless manner and also have the freedom to also build a lot of the stuff that you have imagined previously, but it's just not possible to do in the traditional finance. So that given the large amount of talent we are attracting in the space, I do think that the Robin of the future will be built given enough time. Yep.
Ivan, from a developer's perspective, in terms of technology, do you think we're ready to take the next step level in this space and become a Robinhood, or are we too early in this space still?
Yeah, for me, again, boils down to UX. I think we are attracting a lot of developers. Just found out today that the alpha lead developer has 4 international math Olympiad wins. So a lot of really smart people in the space. But in terms of, so I think what we are not attracting enough of is product people, product managers, product designers who actually understand what's going on. And that's why you see they have like brilliant ideas, but then we throw some random cartoon UI onto it and then just let people figure it out. I mean, it's fine in this experimental stage, but when you want to show it to I don't know, if your mom, your cousin, etc., you want to show it to people during gatherings, you can't really show that to them. If you show something slick like Robinhood, then that's a different level altogether. So yeah, I think we're actually almost there already. If we find something good and then we really focus on it and build it as a nice product, I don't really see what's not there. I don't really see the gap between us and say Robinhood.
A gap between talking and comparing things with your friends in crypto and then giving them to your friends or family who are not real experienced in crypto now. Our last question, we asked the followers about any DeFi project they wanted to talk about. One of them is Thorchain. Arthur, as an investor, are you able to share your long-term look and valuation for Thorchain?
I have no view on Thorchain. It's a project that I did not spend too much time to research on. I only know that they have a very novel method to solve the impermanent loss, and their main premises and value proposition is a privacy-focused cross-chain protocol that you actually do not need to wrap your asset to trade with. You can trade from Bitcoin to Litecoin to Ethereum directly without going through the wrapping process. And they have some sort of economic way of guaranteeing the validator will process this trade. So I think the outlook is very hard to say. I think a lot of things in DeFi is experimental. You really can know it when it's actually launched. So I have a strong preference for projects that are live and working over projects that are still been like testnet. So I think that you just have to launch it and test the market and let the market give you the most obvious and direct feedback instead of just pushing the testnet talking about a big game. So I think that's the best way of validating a project. So valuation, I have no view.
Thorchain, like DMX, is built on Common. Are you able to share how the two platforms may interact together in the future?
So I know Thorchain has this AMM model, this thing that tries to protect against permanent loss, as Arthur mentioned. I haven't investigated too much into that. I haven't really looked too much into that. So to me, I see Thorchain more as a gateway, cross-chain sort of gateway, and that's what interests me the most. So I did speak with some of the developers before, who are in Singapore. I think it's still not 100% there yet, but they are doing some quite technically challenging things in terms of trying to make it as trustless as possible. The other aspect is that I think they wanted to build a DEX. I mean, I spoke to JP, or one of the founders early on before this event came about. So maybe that's the long-term plan. But I think right now there's pivoting more to a gateway solution, and that's where we see some value in. If let's say they're able to do trustless gateway of multiple assets, and if they're integrated to IBC, then we could use their swap gateway from say BTC to Thorchain BTC or whatever, and then use that as a trading collateral. So I think in terms of Switcheo and Thorchain, I think that would be the most interesting aspect for me. Yeah.
Great, thank you. That's all the questions we have. I'd like to thank both Arthur and Ivan for joining us today, the viewers for watching. The video will be available later on YouTube. We've recorded the session. Once again, I'd like to thank Arthur and Ivan. You guys have any last words for our viewers?
No, not really.
Go ahead, Arthur. Go ahead.
I think that DeFi is just like I believe DeFi is a secular trend, and also that there's a lot of a very interesting experiment going on. So just approach it with an open mind thinking, and just to best is to be the user to actually test out the various product and use that as your own guide to what you think that what kind of value different DeFi protocol is providing to you. Yep.
Any last words?
No, it's been great chatting with you, Arthur. And thanks, Luke, for helping out with this.
Thank you, both of you.
Thank you.
All right,
Bye.
bye.